paper money system, as we've known it for over 50 years, is reaching a critical inflection point, and what I'm about to share with you isn't speculation or fear-mongering. It's a pattern that's played out throughout history, and right now, we're watching it unfold in real time with a speed and intensity that's catching even seasoned investors off guard. Let me start by asking you something. When was the last time you heard a central bank governor, a treasury secretary, or a major financial institution publicly admit that the monetary system might have fundamental problems? They don't. They can't. Because the moment they do, confidence evaporates. But here's what they're doing instead, and this is where it gets interesting. They're buying gold. Not just a little bit. They're accumulating physical gold at a pace we haven't seen since the early 1970s, right before the last major monetary reset. Think about that for a second. The very institutions that print money, that control interest rates, that tell us inflation is transitory and everything is under control, they're converting their reserves into the one asset that's been money for 5,000 years. Why would they do that if paper currencies were stable? Why would they do that if they believed in the system they're managing? Now, I want you to understand something crucial here. This isn't about gold bugs versus paper money advocates. This isn't about ideology. This is about mathematics, physics, and human nature. Every fiat currency in history, every single one, has eventually failed. Not most of them, all of them. The average lifespan of a fiat currency is around 27 years. The US dollar has been a pure fiat currency since 1971. Do the math. But here's where most people get it wrong. They think the collapse happens overnight. They imagine some dramatic moment where suddenly your dollars are worthless. That's not how it works. It's a slow bleed at first, then it accelerates. You're living through the slow bleed right now. Your grocery bill that's doubled, your energy costs that keep climbing, your savings account that's losing purchasing power every single day, even though the number stays the same. That's not inflation in the traditional sense. That's currency debasement. That's the exit closing. Let me paint you a picture of what's actually happening behind the scenes. The COMEX, which is the major exchange where gold and silver futures are traded, has been showing some really interesting stress patterns. The ratio of paper claims to physical metal has been expanding. What does that mean in plain English? It means there are more people holding contracts that say they own gold than there is actual gold to deliver. It's like a game of musical chairs, except when the music stops, most people are going to find out they're holding a piece of paper, not a piece of metal. And before we go further, I want to mention something quickly. I've put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No cost, no obligation, just information that might be relevant to your situation. Grab it if you want it. Now back to what's happening. The commercial banks, the ones that are supposed to be the smart money, they've been reducing their short positions in gold. That's significant. These are the institutions that have been betting against gold for years, keeping the price suppressed through paper contracts. When they start covering those shorts, when they start stepping aside, that tells you something big is shifting. But let's zoom out even further. Let's talk about what's happening at the sovereign level, because this is where the real story is. Central banks globally have been net buyers of gold for over a decade now, but the pace has intensified dramatically. China, Russia, India, Turkey, Poland, Hungary, these aren't small players. These are nations that understand monetary history. They're not buying gold because they think it's going to go up 10 or 20%. They're buying gold because they're preparing for a monetary system that looks fundamentally different from the one we have today. You know what's fascinating? When you look at the official numbers, they're impressive enough. But the unofficial numbers, the gold that's being accumulated through back channels, through private transactions that don't show up in the official statistics, that's where the real accumulation is happening. How do we know this? Because the refineries can't keep up. The Swiss refineries, which process the majority of the world's gold, they're running at full capacity, and they're still backed up with orders. Let me tell you a story that illustrates what's really going on. There's a major European bank, I won't name them, but they're one of the big ones. A few years ago, they offered a gold storage service. You could buy gold through them, and they'd store it in their vaults. Seemed convenient, right? Well, some of their larger clients started asking to take physical delivery. Not all of it, just a portion. And you know what happened? Delays, excuses. The gold is in a different vault. We need a few weeks to arrange transport. There's paperwork that needs to be filed. These are the kinds of responses you get when someone doesn't actually have what they claim to have. Now multiply that story by thousands of institutions, millions of accounts, and you start to see the problem. The paper gold market, the market where gold is traded through contracts and certificates and ETFs, it's massive. It dwarfs the physical market, but it's built on a foundation of trust. Trust that when you want to convert your paper claim into physical metal, you can. What happens when that trust breaks? Here's where it gets even more interesting. The industrial demand for silver, which often gets overlooked in these discussions, is absolutely exploding. Solar panels, electric vehicles, 5G infrastructure, medical applications, every major technological trend of the next decade requires silver. And unlike gold, which is mostly recycled and reused, silver gets consumed. It's used in tiny amounts in thousands of applications, and it's not economically viable to recover it. That silver is gone. So you've got industrial demand increasing, investment demand increasing because people are waking up to what's happening with currencies, and mine supply that's been relatively flat for years. The primary silver mines, the ones that dig specifically for silver, they're not expanding. Most silver comes as a byproduct of copper, lead, and zinc mining. When those operations slow down, silver supply contracts. It's a supply-demand equation that doesn't balance, and the only variable that can adjust is price. But here's what most people don't understand about price in the precious metals market. The price you see quoted, the spot price, that's determined in the paper market. It's determined by contracts that are settled in cash, not metal. The physical market, where actual metal changes hands, that's showing premiums that are significantly higher than spot. In some cases, you're paying 20, 30, even 40% over spot to get physical metal in your hands. That spread, that premium, that's telling you something. It's telling you that the paper price and the physical reality are diverging. Now, I want to talk about something that doesn't get enough attention: the velocity of money. It's a concept in economics that measures how fast money moves through the economy. When velocity is high, each dollar is changing hands frequently, facilitating lots of transactions. When velocity is low, money is sitting idle. Right now, despite all the money printing, despite all the stimulus, velocity is at historic lows. What does that mean? It means people and institutions are hoarding cash, not spending it. They're waiting, they're uncertain, and when that dam breaks, when that money starts moving, the inflation we've seen so far is going to look tame. Think about what happened in Weimar Germany. Everyone knows the story of people carrying wheelbarrows of cash to buy bread, but that didn't happen overnight. For months, for years even, the government printed money and things seemed okay. Prices went up, but gradually. People adjusted. And then suddenly, it wasn't gradual anymore. The psychological shift happened. People lost faith in the currency, and when that happens, no amount of government intervention can stop it. The currency dies not because of the printing, but because of the loss of confidence. We're seeing the early stages of that loss of confidence now. It's not dramatic yet. It's subtle. It's people buying a little gold here, a little silver there. It's pension funds quietly increasing their allocation to hard assets. It's billionaires building bunkers and buying farmland. These aren't crazy people. These are people with access to information, with advisors who understand how systems fail. And here's something that should concern everyone. The derivative market, the market for financial contracts based on underlying assets, it's enormous. We're talking quadrillions of dollars in notional value. A significant portion of that is tied to interest rates and currencies. What happens when currencies become unstable? What happens when counterparties can't meet their obligations? The whole structure is interconnected. It's like a house of cards, and precious metals, physical precious metals, are outside that system. They're not someone else's liability. They're not dependent on a counterparty's promise to pay. Let me shift gears for a moment and talk about something practical. If you're sitting on retirement accounts, if you've got $100,000 or more in IRAs or 401ks, you need to understand that there are options available to you that most people don't know about. Gold IRAs, for instance. They allow you to hold physical precious metals in a tax-advantaged retirement account. I've put together a comprehensive guide on how this works, how to do it without triggering tax penalties, and what to watch out for. It's in the description. This isn't about making a quick buck. This is about protecting what you've spent decades building, especially with everything we're seeing in terms of market instability, geopolitical tensions, and monetary policy that seems to be making things worse, not better. Now back to the bigger picture. Let's talk about what happens when the exit actually closes. And by exit, I mean the ability to convert paper wealth into hard assets at reasonable prices. Right now, you can still do it. It's getting more expensive, premiums are rising, delivery times are extending, but you can still do it. There will come a point where that changes, where the premium becomes so high that it's prohibitive, where the wait time becomes so long that it's impractical, where dealers simply stop selling because they can't source metal. We saw a preview of this during the pandemic. Mints shut down, refineries closed, supply chains broke, and even though the paper price of silver actually dropped during the initial panic, try buying physical silver. You couldn't. And if you could, you were paying massive premiums. That was a temporary disruption. Imagine what happens during a monetary crisis that doesn't resolve in a few months. Here's another angle that's crucial to understand: the energy cost of mining. It takes a tremendous amount of energy to extract gold and silver from the earth. As energy prices rise, and they are rising, the cost of production goes up. Mines that were profitable at lower energy prices become marginal or unprofitable. Production decreases, but demand doesn't decrease. If anything, it increases as people seek safety. Again, it's a supply-demand equation that only resolves through higher prices. And let's talk about the geopolitical dimension for a moment. The dollar's role as the world's reserve currency has given the United States enormous advantages. It's allowed the country to run massive deficits, to print money without immediate consequences, to essentially export inflation to the rest of the world. But that system is being challenged. The BRICS nations, Brazil, Russia, India, China, South Africa, they're working on alternative payment systems. They're settling trade in their own currencies. They're accumulating gold as a neutral reserve asset that no single country controls. This isn't happening because they hate America. It's happening because they've watched what happens when you're dependent on a system controlled by someone else. They've seen sanctions used as weapons. They've seen accounts frozen. They've seen the rules change mid-game, and they're building alternatives. When those alternatives reach critical mass, when enough global trade is happening outside the dollar system, the demand for dollars drops. And when demand for dollars drops, the value drops. And when the value drops, everything priced in dollars, including your savings, loses purchasing power. Now, some people will say, but the dollar is strong right now. Look at the dollar index. And they're right in a relative sense. The dollar is strong compared to other fiat currencies. But that's like being the tallest person in a room full of people standing in a hole. It doesn't mean you're actually tall. It means everyone else is sinking faster. The dollar index measures the dollar against a basket of other currencies, euros, yen, pounds. All of those currencies are being debased. All of those central banks are printing. So yes, the dollar can be strong relative to them while still losing value in absolute terms. And this is where gold and silver come in. They're not measured against other currencies. They're measured against themselves. An ounce of gold today is the same ounce of gold it was 100 years ago. Its purchasing power, its ability to buy real goods and services, that's remained remarkably stable over long periods of time. Not year to year, not even decade to decade necessarily, but over the long arc of history, gold maintains its value. Currencies don't. Let me give you a concrete example. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, gold was $35 an ounce. A new car cost about $3,000. So you needed roughly 85 ounces of gold to buy a car. Today, gold is trading at multi-$1,000 levels, and a new car costs $30,000, $40,000, $50,000, depending on what you're buying. But guess what? You still need roughly the same amount of gold to buy that car. The relationship between gold and real goods has remained stable. The relationship between dollars and real goods has not. This is what people mean when they say gold is insurance. It's not that gold goes up in value, it's that currencies go down in value, and gold maintains its purchasing power. It's a store of value across time. And in an era where governments are printing money at unprecedented rates, where debt levels are at historic highs, where the temptation to inflate away obligations is overwhelming, having a portion of your wealth in something that can't be printed, that can't be debased, that's not dependent on any government's promise, that's not just smart, it's essential. Now let's talk about timing, because this is where it gets tricky. Nobody can tell you exactly when the system breaks. Nobody can tell you the exact day or month or even year when confidence evaporates and the rush for the exits begins. What we can tell you is that the conditions are in place. The debt is unsustainable. The money printing is accelerating. The geopolitical tensions are rising. The alternatives to the dollar system are being built. All the ingredients are there. And here's the thing about timing. You don't need to time it perfectly. In fact, trying to time it perfectly is a mistake. What you need to do is position yourself before the crowd realizes what's happening. Because once the crowd realizes it, once it becomes obvious to everyone, the exit is already closed. The premiums are already sky high. The metal is already unavailable. The opportunity to protect yourself at reasonable prices is already gone. Think about it like this. Imagine you're in a theater and you smell smoke. You look around and nobody else seems concerned. Do you wait until everyone else smells it? Do you wait until the alarm goes off? Do you wait until you see flames? Or do you quietly make your way to the exit while it's still clear? The people who survive these situations are the ones who act on early warning signs, not the ones who wait for confirmation. And the early warning signs are everywhere if you know what to look for. The central bank buying, the supply constraints, the premium expansion, the geopolitical maneuvering, the debt levels, the money printing, the inflation that's not transitory despite what they told us, the loss of confidence in institutions, the political polarization that makes solving problems harder, the technological disruptions that are accelerating change. All of it points in the same direction. Here's something else to consider. The paper gold market, the futures market, it's designed to suppress price. That's not a conspiracy theory. That's how it works. When you can create unlimited paper claims on a finite physical asset, you can influence the price. You can make it appear that there's more supply than there actually is. But that only works as long as people are willing to accept paper instead of demanding physical. The moment people start demanding physical delivery and size, the game is over. The price has to adjust to reflect actual physical supply and demand, not paper supply and demand. We're seeing signs that this shift is beginning. The COMEX inventories have been declining. The registered gold, the gold that's available for delivery, it's at levels that are concerning relative to the open interest, the number of contracts that could demand delivery. Now, most contracts are settled in cash, not metal. That's how the system works. But what happens if that changes? What happens if a larger percentage of contract holders demand physical delivery? The exchange would have to either deliver metal it doesn't have, or default on contracts, or change the rules. And changing the rules, forcing cash settlement when people want metal, that's the kind of thing that breaks confidence in the entire system. Silver is even more interesting in this regard because the market is smaller. The total value of all the silver in the world is a fraction of the total value of all the gold. It would take far less money flowing into silver to move the price dramatically. And yet silver has all these industrial uses that create constant demand. It's a unique situation. A monetary metal with industrial applications in a market that's small enough to be moved by relatively modest amounts of capital with supply constraints that are real and growing. Now I want to address something that comes up a lot. People say, but if the system collapses, if currencies fail, won't the government just confiscate gold like they did in 1933? It's a fair question. And yes, Roosevelt did issue an executive order requiring Americans to turn in their gold, but context matters. That was during the Great Depression, when the dollar was still backed by gold, and the government needed gold to maintain that backing while devaluing the currency. Today, the dollar isn't backed by gold. There's no need to confiscate it to maintain a peg that doesn't exist. Could they try anyway? Sure. Governments can do a lot of things, but enforcement would be nearly impossible. How do you track gold that's held privately? How do you search every home, every safe deposit box, every hiding place? And more importantly, why would they? If they want to devalue the currency, they can just print more money. They don't need your gold to do that. The more likely scenario is that they try to tax gains heavily, or they try to restrict trading, or they try to create a government-backed digital currency that they can control completely. But outright confiscation of physical gold? It's possible, but it's not the most likely scenario. And even if it were, even if that risk exists, what's the alternative? Holding all your wealth in a currency that's guaranteed to lose value? Holding it in a banking system that can freeze your accounts with a keystroke? Holding it in markets that can crash? Every option has risks. The question is, which risks are you most comfortable with, and which assets give you the most optionality, the most flexibility to respond to whatever actually happens? This is why diversification matters. This is why having some portion of your wealth in physical precious metals, outside the banking system, outside the digital system, makes sense regardless of what specific scenario unfolds. It's not about predicting the future perfectly. It's about being prepared for a range of possible futures. Let me bring this back to something practical and immediate. If you've made it this far in this video, if you're still watching, that tells me you're taking this seriously. You're not just looking for entertainment. You're looking for information that can help you make better decisions. And I want to reward that. The guide I mentioned earlier, the one in the description, if you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference. No obligation, no sales pitch, just education on your options. It's only available to people who've watched to the end, because I want to work with people who are serious, who are willing to put in the time to understand what's happening. Now let's wrap this up with the big picture. The paper money exit is closing. Not because I say so, not because of any one data point or event, but because of the cumulative weight of decades of decisions, of debt accumulation, of money printing, of promises that can't be kept. The mathematics don't work, the physics don't work. You can't print prosperity, you can't borrow your way out of debt, you can't maintain confidence in a currency that's being systematically debased. History shows us how this ends. It's not pretty, but it's also not the end of the world. Wealth doesn't disappear. It transfers. It moves from those who are unprepared to those who are prepared, from those who trusted the system to those who understood the system's limitations, from those who held paper to those who held real assets. The question you need to ask yourself is simple. Which side of that transfer do you want to be on? Do you want to be the person who wakes up one day and realizes their savings have lost half their purchasing power or more? Or do you want to be the person who saw it coming, who took action while action was still possible, who protected what they'd worked their whole life to build? The exit is still open, but it's closing. The premiums are rising. The supply is tightening. The warning signs are multiplying. How much more evidence do you need? What are you waiting for? Permission? Confirmation from the mainstream media? A government announcement that it's time to protect yourself? That's not how this works. By the time it's obvious to everyone, it's too late. You have a choice to make. You can continue trusting a system that's showing every sign of stress, every indication of instability. Or you can take a portion of your wealth, convert it into something that's been money for 5,000 years, something that survived every currency collapse, every empire's fall, every monetary reset, something that central banks are accumulating even as they tell you everything is fine. The paper money exit is closing. The question is whether you'll walk through it while you still can, or whether you'll be part of the crowd that realizes too late what was happening. The choice is yours. The information is available. The opportunity still exists. But time is running out. Make your decision. Take action. Protect what's yours. Because nobody else is going to do it for you.